Home prices in your city are finally coming down, but your monthly bills are going up. Mortgage payments stay high, insurance premiums rise, property taxes don't fall, and suddenly, owning a cheaper home feels more expensive than ever. Across Ohio, a state once marketed as America's safe housing zone, this contradiction is playing out quietly. Sellers are cutting prices. Listings sit longer. Buyers hesitate. And homeowners who thought they were protected are discovering how fragile that protection really was. So here's the question no one wants to ask. Which Ohio cities are quietly draining wealth from the people who live there, right now in 2026? To understand what's happening inside these Ohio cities, you first have to understand why this housing cycle feels different from the ones before it. This is not a simple price correction driven by panic selling. It's a slow grind created by math that no longer works. Over the past few years, home prices across the United States surged on cheap money, investor demand, and a belief that migration would only move in one direction. Buyers rushed in. Investors scaled up. Builders added supply. And many households stretched to the edge of what they could qualify for, trusting that rising values would cover the risk. Then the environment changed. Interest rates reversed sharply. Monthly payments doubled compared to the low-rate era, even when prices stopped rising. At the same time, inflation pushed up the cost of everything tied to owning a home: insurance, utilities, maintenance, taxes, and repairs. In many markets, prices softened, but ownership costs did not. This created a new kind of pressure. Buyers didn't disappear because homes were unaffordable on paper. They stepped back because the margin for error vanished. One unexpected repair, one insurance hike, one job disruption. That's all it takes to turn a good deal into a financial trap. Investor behavior shifted as well. Large buyers became selective. Small landlords discovered that rents have ceilings, especially in cities where wages never caught up to home prices. Vacancy rates quietly rose. Concessions returned. And properties that once moved in days began sitting for months. What makes this cycle especially dangerous is that many cities are dealing with structural issues at the same time: aging infrastructure, older housing stock, rising climate and insurance risks, and uneven job growth. Unlike past downturns, there is no clear growth engine waiting to restart demand. This is where Ohio enters the picture. For years, Ohio was marketed as the safe alternative: affordable homes, stable jobs, no dramatic booms or busts. But in 2026, that reputation is being tested city by city. Before we break down the 7 Ohio cities where housing stress is becoming impossible to ignore, take a moment to support the channel. If you value clear, data-driven analysis without hype, like the video, subscribe, and turn on notifications so you don't miss the next deep dive. Now, let's move from the national picture to the street-level reality. Starting with a city many buyers once saw as a bargain hiding in plain sight. 1. Springfield. For years, Springfield looked like a quiet workaround for buyers priced out of larger Ohio metros. Now, sitting between Dayton and Columbus, it offered older homes, larger lots, and what seemed like manageable commutes. On paper, it checked all the boxes of an affordable market. During the low-rate years, that perception pulled in outside buyers and small investors. Prices rose faster than the city's economic base ever had. Duplexes and single-family rentals were scooped up. Asking prices climbed, and many buyers assumed Springfield was simply catching up. But the math never truly changed. Most jobs in Springfield remain concentrated in logistics, manufacturing, healthcare, and retail. These are steady sectors, but they don't support rapidly rising housing costs. When interest rates climbed and inflation hit household budgets, the gap between wages and housing expenses became impossible to ignore. By 2026, yet the stress is visible in the listings. Homes linger on the market. Price reductions stack up. Sellers quietly walk numbers back, chasing a shrinking pool of qualified buyers. Deals fall apart when appraisals come in low, or inspections reveal problems buyers once overlooked. Springfield's aging housing stock makes everything worse. Many homes need real investment: roofs, electrical systems, furnaces, windows. During the boom, buyers accepted those risks. Now, inspection reports kill momentum. Repair costs collide with higher insurance premiums and rising utility bills. On the rental side, expectations are adjusting downward. Rents have ceilings. Vacancies last longer. Investors who once talked about effortless cash flow are discovering that maintenance, turnover, and insurance eat away returns faster than planned. And a Springfield's lesson is simple but uncomfortable. A home can look affordable at the sticker price and still be unaffordable to own. So, if this is what's happening in one of Ohio's in-between markets, what happens in cities that have been shrinking for decades? 2. Youngstown. Youngstown has long been used as shorthand for industrial decline. Factory closures, population loss, and vacant neighborhoods turn the city into a national symbol of what happens when an economic engine shuts down. In recent years, however, a quieter narrative began to circulate: that the worst was over. Prices were low. Renovations were visible in select pockets. Some investors and remote workers believed Youngstown had already bottomed and that the next move had to be up. That optimism was fragile. By 2026, Youngstown's housing market shows how difficult it is to rebuild when the foundation remains weak. While a few downtown projects and renovated blocks created optimism, large parts of the city continue to struggle with abandoned homes, empty lots, and thin demand. Housing prices here never surge dramatically, but that doesn't mean risk is low. In a city where incomes are modest and savings are thin, even small increases in monthly costs can destabilize households. Higher interest rates, rising insurance premiums, and surprise repair bills push buyers and owners past their breaking point. Warning signs are everywhere if you know where to look. Foreclosure filings and tax delinquency notices carry more weight here than in wealthier markets. One renovated home with a hopeful listing can sit next to multiple boarded-up properties, dragging down appraisals and buyer confidence at the same time. Lenders and buyers price in that risk. As a result, values stay compressed even when individual homes improve. Investors hoping for quick flips or smooth rent growth are running into reality. Rents aren't rising fast enough. Vacancies last longer. Exit options are limited. Youngstown isn't collapsing overnight, but it is a reminder that cheap housing does not equal safe housing. In 2026, owning property here often means committing to a long, uncomfortable hold in a city still fighting demographic gravity. And if that's the reality in a city that already reset, what happens in places that thought stability alone would protect them? 3. Dayton. For a long time, Dayton was described as one of Ohio's more stable housing markets. It wasn't flashy, and it didn't boom like coastal cities. With major highways, logistics hubs, defense-related employers, and a long aviation history, Dayton felt grounded. That reputation attracted buyers looking for safety rather than upside. As prices rose elsewhere in Ohio, Dayton quietly became a target for bargain hunters. Investors moved into neighborhoods near downtown and close to major employers. Renovations followed. Prices climbed faster than wages, but the narrative stayed optimistic. Steady jobs, reasonable commutes, manageable risk. By 2026, that confidence is under pressure. The problem isn't a sudden collapse, it's the disappearance of margin. Many Dayton households operate with limited financial buffers. When interest rates climbed and inflation pushed up food, gas, utilities, and insurance, that even modest mortgage payments began to feel heavy. On the market, signs of strain are building. Homes renovated for top-of-cycle prices sit longer than expected. Sellers compete for the same cautious buyers. Appraisals come in conservative. Negotiations grow tense. What once felt like a balanced market now favors buyers who can afford to wait. Quality of life factors add another layer of friction. School performance, neighborhood safety, and aging infrastructure vary widely across the city. For families, those differences matter. When a buyer can drive an extra 20 minutes and feel more secure, that option becomes hard to ignore. Landlords face similar constraints. Rent growth has slowed, but operating costs have not. Tenants pushed by inflation struggle to absorb increases. Missed payments and turnover erode returns that once looked dependable. Dayton's housing market isn't broken, but it is exposed. In 2026, the city shows how quickly stability turns fragile when the cushion disappears. And if even a safe city like Dayton is under pressure, what happens when environmental and infrastructure risks enter the picture? 4. Toledo. Toledo has long been one of Ohio's cheapest cities to buy a home. As a Great Lakes port with an industrial past, it attracted two types of buyers during the last cycle: investors chasing high percentage returns, and households fleeing more expensive metros who wanted to own outright or carry very small mortgages. On the surface, it looked like a rational move, but Toledo's affordability masked deeper vulnerabilities. Job growth remained uneven. Population trends stayed flat. And while some neighborhoods improved, others continued to slide, weighed down by vacant properties and deferred maintenance. By 2026, those contradictions are harder to ignore. Listings sit longer. Sellers who anchored expectations to peak pricing face aggressive negotiations. Out-of-town investors are more cautious after watching similar cash flow cities disappoint elsewhere. The buyer pool is thinner, and every deal faces scrutiny. Environmental and infrastructure risks add pressure unique to Toledo's location. Algae blooms, water quality concerns, basement flooding, and drainage issues are no longer abstract problems. They show up in inspection reports, insurance quotes, and maintenance budgets. Older homes near vulnerable corridors carry hidden costs that buyers now factor in upfront. For many owners, and the choice is uncomfortable. Invest heavily to modernize aging systems and hope the market rewards it later, or accept a steep discount and move on. Neither option feels appealing when capital is tight and demand is uncertain. Toledo's experience delivers a blunt warning. Low purchase prices do not eliminate risk, they often concentrate it. In 2026, Toledo's housing market reflects what happens when affordability collides with aging infrastructure and environmental stress. And if cheap cities face these challenges, what about larger metros where prices ran much further ahead of fundamentals? 5. Cincinnati. For years, Cincinnati carried a reputation for balance. It wasn't as volatile as Sunbelt boomtowns, but it wasn't stagnant either. Riverfront redevelopment, revitalized neighborhoods, and a steady mix of old industry and new investment helped sell the image of a city growing at a controlled pace. That perception attracted buyers and investors looking for reliability. During the low-rate years, demand surged. Renovated homes near downtown and popular employment centers sold at prices that would have seemed unrealistic not long ago. Breweries, entertainment districts, and lifestyle branding reinforced the revival narrative. Suburbs across the river and along the Beltway followed the same trajectory. By 2026, the strain is showing. In several neighborhoods, prices have outpaced what local incomes comfortably support. Small homes on narrow lots now carry monthly payments that feel heavy once property taxes, insurance, and utilities are added in. Those taxes, based on past appreciation, haven't adjusted downward, even as buyer enthusiasm cools. Financing changes everything for investors. Deals that penciled out when borrowing was cheap now struggle under higher rates. Vacancy has crept up in older properties that lack modern layouts or amenities. Owners face a choice: invest more capital to stay competitive, or lower expectations and accept thinner margins. Cincinnati's geography adds another layer of complexity. Hillside neighborhoods face drainage and stability issues. River adjacency brings both scenic value and flood exposure. Insurance pricing reflects those risks more directly now, surprising buyers who focused only on purchase price, when Cincinnati still has real strengths. But in 2026, those strengths don't protect every buyer. The most exposed are those who stretch to the limit in neighborhoods driven more by buzz than long-term fundamentals. And if a city known for moderation is feeling this pressure, what happens when rapid growth itself becomes the risk? 6. Columbus, Columbus has been Ohio's growth engine for more than a decade. A major university, state government, corporate headquarters, and expanding tech and healthcare sectors fueled steady population gains. For years, Columbus was held up as proof that Ohio could still produce a modern, resilient housing market. That success became its own risk. During the low interest rate era, money rushed in. New apartment towers rose, suburban subdivisions expanded outward, and infill projects transformed older neighborhoods. Buyers competed aggressively to get into specific school districts, commute corridors, and zip codes. The message was clear: buy now or be permanently priced out. By 2026, that narrative has hit resistance. Home prices in many parts of Columbus no longer align with what local buyers can comfortably afford. Even households with two solid incomes feel squeezed once mortgage payments are combined with property taxes, insurance, utilities, student loans, and childcare. The math works only if nothing goes wrong, and that's a dangerous assumption. At the same time, the rental market shows early signs of softness. New luxury units compete for tenants with move-in specials and free months. Investors who expected nonstop rent growth are recalculating. Some are quietly listing properties, hoping to exit before prices drift lower. Columbus also faces growing pains typical of fast expansion: traffic congestion, school crowding, uneven infrastructure, and neighborhood pushback against development-shaped buyer behavior. Some areas feel overbuilt, others feel left behind. That unevenness creates pockets of weakness, even within a city still adding jobs. Columbus isn't collapsing, but it is priced for perfection. And when a market requires perfect conditions to hold its value, even small disappointments can trigger real stress. If this is happening in Ohio's strongest market, what does that say about the city carrying the most unresolved risk? 7. Cleveland. Cleveland sits at the top of this list because it concentrates nearly every risk facing Ohio's housing market into one place. In a legacy industrial city on the shores of Lake Erie, Cleveland has spent years selling a comeback story built on selective revitalization and outside optimism. In certain areas, that story looked convincing: downtown renovations, entertainment districts, new restaurants, and converted lofts pushed prices sharply higher from very low starting points. Out-of-state investors saw upward charts and jumped in, buying rentals, flips, and small portfolios, confident they had found Midwest upside. But the broader reality never changed. Cleveland as a whole continues to struggle with population loss, persistent poverty, and uneven public services. For every block that appears revitalized, there are several more weighed down by vacant homes, empty lots, and aging infrastructure. That imbalance matters when the market tightens. By 2026, the thin layer of demand supporting higher prices in select neighborhoods is weakening. Listings sit longer. Price cuts are more common. Buyers hesitate once inspections reveal familiar issues: roof damage, foundation concerns, moisture intrusion, and outdated systems. Lake effect storms and flooding risks add another layer of cost and uncertainty. Insurance premiums and deductibles are adjusting to those realities. So are lenders and appraisers. Values are being reassessed not by marketing narratives, but by street-level conditions. For homeowners who bought late in the cycle, the pressure is real. Some owe more than a realistic sale would bring. Others discover that finding a buyer willing to meet their expectations is far harder than it looked when headlines focused only on revival. Cleveland still has committed residents and genuine potential. But in 2026, it stands as Ohio's clearest example of what happens when hope runs ahead of fundamentals, and the gap between promise and reality becomes too wide to ignore. What this tour through Ohio really reveals is not 7 separate problems, but one repeating pattern. Across these cities, prices moved ahead of local incomes. Investors chased the same strategies. Buyers stretched, believing that affordability alone meant safety. And during the rush, aging homes, fragile infrastructure, and rising ownership costs were pushed into the background. In 2026, those ignored details are back, and they are expensive. The common thread isn't just falling prices. It's the reality that total cost of ownership keeps rising, even as home values soften. Insurance premiums don't fall with listing prices. Property taxes adjust slowly. Repairs become unavoidable. And when wages remain flat, every increase hits harder. This is why the balance of power has shifted. Sellers are negotiating. Buyers are cautious. Investors are selective or exiting quietly. And households who bought late in the cycle are discovering that lower prices don't automatically mean relief. Ohio was never supposed to be risky. It was marketed as the safe zone. But safety was built on assumptions that no longer hold: cheap money, endless demand, and the belief that prices only move in one direction. The lesson here is not that every Ohio city is doomed, it's that blind confidence is. If you're thinking about buying, selling, or holding property in any of these markets, this is the moment to slow down. Look past the sticker price, examine the math. Ask who can really afford to live there, and for how long. So here's the question to leave you with. Is this just a temporary reset, or the beginning of a longer adjustment that reshapes what affordable housing truly means? If this breakdown helped clarify what's happening beneath the surface, like the video, subscribe to the channel and turn on notifications so you don't miss the next deep dive. And let us know in the comments, what are you seeing in your city right now? Because the 2026 housing shift isn't just a coastal story anymore. It's happening in places people once believed were untouchable.